stories like that speak to how these businesses aren't really operating on the general ledger and the numbers coming out of it. I can't believe Uber was making all their critical business decisions when worth tens of billions of dollars without any insight into their business. And my guess is, without knowing anyone over there, that they were viewing their QuickBooks instance as an afterthought. No, well, we just have to get the books done. And like us, they were making business decisions on non-accounting systems.
Do you have any startup clients on QuickBooks Online that someday plan to go public? Are you a CFO dreading the need to migrate to an expensive and complicated ERP just so you can clear all those SOX compliance hurdles? What if you could be SOX compliant, go public, and stay on QuickBooks Online? Stay tuned to hear more from our sponsor Avise later in the episode. If you'd like to earn CPE credit for listening to this episode, visit earmarkcpe.com, download the app, take a short quiz, and get your CPE certificate. Continuing education has never been so easy. And now, on to the episode. Welcome, everyone, to another episode of the Earmark Accounting Podcast. I am your host, Blake Oliver, CPA, and I feel like today we have hit the big leagues. We are a new level of production here with our guest today, Graham Stanton, co-founder of Peloton. Graham, welcome to the show.
Well, thank you, Blake. I feel like I've hit the big leagues just by being here, so really appreciate it.
I am so eager to talk to you about your experience at Peloton and your new business that you have started, Avise. But first, for our listeners that are curious and confused, what brings the co-founder of Peloton to a show about accounting?
Well, that is a good question.
Do you have a finance or accounting background? Are you an accountant?
Yeah, why not just jump right into it? I mean, I'm not an accountant. I have something of a background. My dad was an accountant. My grandfather was an accountant.
It's in the blood.
Yeah, it's in the blood. But no, I say that I joke that I drew the short straw in having to figure it out at Peloton among the co-founders, just because I had some exposure to some accounting in the past and finance. And I learned just how hard it is to actually do accounting.
So you and your co-founders, how many of you were there?
So there were 5 of us total.
5 co-founders. Okay. And everybody was deciding, what am I going to do? How am I going to, help Peloton grow? And you got assigned accounting, finance. Did you volunteer for it? Was it just like somebody has to do it, so I'll do it?
Yeah, I think that's probably the best way to look at it. It's the way it goes at a number of startups, most startups, I'd say, where there's just so much to get done. Everyone's running around. And we just all pitched in as we could. So I worked as a paralegal for some of it. I actually wrote a lot of the Android code for the tablet because I used to be a software engineer at one point. I did a lot of the marketing and got finance and accounting started.
So you said your father was an accountant, is that right?
Yes, he was.
And what kind of accountant? What did he do?
Well, he was he did public accounting. He was an auditor at one of the big 6 firms, as he puts it.
Okay. So I imagine, was that while you were growing up? Was he gone doing audits, or did he have his own firm at some point?
Yeah, that's a good question, man. How did that actually affect my formative years? Yeah, he was. In my youngest years, yeah, absolutely. He was off doing audits at the big firm, and then he switched over after 12 years of public accounting. He went in-house and took a CFO job.
Got it. So I imagine he was around a lot more after that, probably.
Yeah, I mean, he still worked pretty hard, but tough to match audit firm life, especially when establishing oneself.
So I've got to confess, I don't own a Peloton. I've
Mm.
never used a Peloton. I don't, to be honest, have much of a desire to ride on a Peloton bike. Although I know that there are many other products that Peloton is expanding into now. Are you an avid cyclist? Like, did you get into this because you were passionate about the device itself, or was it more of a just a business opportunity? Here is something that I can participate in growing.
Yeah, it was a little bit of both, I would say. As fortune had it, there was a couple friends of mine, old coworkers, who were just getting started and asked if I wanted to join. And a few months prior, I had taken my first indoor cycling class and found it to be a lot of fun. But no, I mean, I wasn't a cyclist by background, wasn't like a big fitness person, and I think that was really a part of what made things work out because we didn't really, none of us came from that world. A couple of my co-founders are a lot more athletic than I am, but none of us was like a professional fitness entrepreneur or trainer or anything like that. We were just passionate about delivering a good user experience and um,
Oh, that's
packaging up something that was fun.
yeah, that's interesting because I think a lot of times with startups or products, there's always one person who had this vision for a product that they themselves wanted, and so then they go out and create the company to build it. But you're saying that it wasn't that there wasn't like a single person who had that vision.
Well, I would say that I would say that John Foley, the founding CEO, had that vision for a product that he himself wanted
Okay.
or his wife wanted. And he did a good job selling that vision to the rest of us. And so we all wanted it. But he wanted that as a consumer. And that's how we all approached it. And I think, talk a little bit, as we continue about how that eventually transitioned into starting an accounting software company.
Yes.
And there are some real parallels there of how, I mean, I wasn't a fitness trainer beforehand. None of us were. And, I'm not an accountant by background and certainly not a professional, wasn't a professional accounting software creator, but I wanted to create the software that I myself would use. And I should also say that my co-founder, who is an actual CPA, would also use.
So let's talk about that journey then. So take me back to the beginning at Peloton. You are going to take on accounting. Did you just sign up for QuickBooks? Like, how did it begin?
It began with my showing up for my first day of work in our office in the garment district in New York City, and my co-founder, the CEO, was sending me a spreadsheet of all the expenses the company had incurred to date, and saying, "Well, we should probably do something with this. Let's figure it out."
So just like an
I
Excel file, he sends you what
Yep,
like he exported from the bank and categorized transactions and sends you that and says this is what we got. This is where we're at right now.
it wasn't even that. It was manually maintained. I mean, he was meticulous about keeping track of every penny that had been spent. But rather than entering that into QuickBooks or some piece of accounting software, or thinking in terms of double entry bookkeeping, it was really something of a single entry accounting. This is what we've done.
Here's the expenses. That's it. Well, I guess in a startup it's easy, right? Because at the beginning you just got burned. You're just spending money. So
Yeah, it's pretty straightforward. Yeah, there's no revenue. There's for accrual accounting, there's minimal in terms of of short term liabilities still out there. It really is just this is the cash we spent. So it was not that hard to get started, but we did initially work with a local CPA firm who were great. I think their expertise was more restaurants and car dealerships, and more traditional businesses than a fast-growing startup, but they were at least able to help us get started on QuickBooks and have something of a record.
Got it. So you went to a firm right away. You said, "Help me get set up on an accounting system," and they got you on QuickBooks.
And they did. They recommended a bookkeeper who was great, and I would say, thinking back on it, one of my regrets was that I didn't at least try to do the books myself to get started. I had some sense from having worked in a bigger company that if I was one of the co-founders, it was a violation of segregation of duties if I was also booking journal entries. And of course, that's something of a joke. And it's a tiny company of 5 people. There's no one to care about such a thing. But what it meant was that I didn't end up having a close enough relationship with this accounting firm to actually talk through, okay, well, this is how the business works and how maybe we could, collaboratively figure out how to shape the accounting to represent the business as it was.
Tell me more about that. So you felt they were just doing the books and you didn't have the input that you wanted to have, or you weren't able to shape it the way you wanted to shape it?
Yeah, I think it was a common situation where, yeah, as you said, they were doing the books and that was their mandate, and I did. And in hindsight, I realized I never asked for anything else. I think probably most people don't. And what that meant was they could file our taxes. They could deliver GAAP compliant financials to make the investors and lenders happy that, okay, well, yeah, we have real financial statements. And we weren't doing audits, but they were able to provide to some degree of review. But we couldn't run the business off any of that. And so what that meant was we ended up maintaining parallel systems, spreadsheets and databases that gave us more insight into the business, but didn't necessarily foot to the official financials.
Got it. So they were doing the books for tax purposes, for reporting to investors, for financial reporting purposes, let's say. You and your co-founders were running Peloton on a separate set of metrics that you were tracking in a different system.
Yeah, I think that's fair to say. And they were pretty close to each other. And if they were ever far off, we could dig into it and explain why. But in most of the business decisions, until it really was time to grow up, and ultimately we had to comply with Sarbanes-Oxley, and everything really had to be all one. But in the years before that, it meant that we had systems that didn't tie to the official financials, that didn't tie to the financials that ultimately were audited, that didn't benefit from the 1,000 years of history behind double entry bookkeeping. And I think we were poorer for it.
So what did you use to do that? Were you doing that in spreadsheets? I'm talking about the management reporting, the reporting you and your co-founders were using. Was it spreadsheets? Was it something else?
Yeah, it was a number of things. So we use so many spreadsheets. We get to the point where, when tracking individual orders and trying to translate things for actually getting into the books down the road.
What were the
50-50? Yeah.
What were the top indicators that you watched, that you and the co-founders were Peloton management, if you will? What were you laser focused on?
We were laser focused on a handful of metrics. The top one was bike sales. And so we were tracking the orders as they came in.
Mm-hmm.
And that already is slightly divorced from GAAP recognition of revenue.
Right.
Yeah, we didn't wait for the bike to show up in someone's home before we acknowledged that the sale had happened. But then there was a potential lots of information between those two. So it was bike sales, and we wanted to make sure that we were getting these bike sales for a reasonable amount of marketing spend. So we were really close to and tracking very carefully how much we spent on each ad channel and how many sales we could actually attribute to that. But that was yet another source of potential mismatch, because we track the ad spend manually in spreadsheets, or we get reports from online advertising portals. And there's a risk that some of those numbers wouldn't necessarily foot to the invoices that we ultimately got that the accounting team would use to book the financials.
So you're saying, like, example, you're doing Facebook ads and you wanted to be able to say, we spent this much on Facebook ads and we generated this many orders for the bikes.
Right, exactly. And we want to know, if we said that we want to average $300 spend per bike sold, but on the margin we go up to $1,500. We'd want to very carefully track that, and we'd use Facebook's online portal to track Facebook spend, and this the same for Google and others. And Facebook, from what I recall, was actually pretty good about the invoices ultimately matching what we had from the online portal, but Google could be off substantially because they had room for a number of adjustments in either direction between the time we pull the data on a daily basis and when they send us the invoice. So there was real risk for us thinking we're super precise and then discovering later that, well, we're not, but we don't know quite where.
This episode of the Earmark Podcast is sponsored by Avise. Avise is a modern accounting system that centralizes and automates accounting workflows within the general ledger to achieve one source of financial truth. Avise consolidates data across multiple entities within the general ledger, giving you the OpEx reports that growing businesses need. Avise can also speed your close with task management, collaboration, and the ability to automate your prepaid, accrual, deferred revenue, and fixed asset schedules. Avise even does flux analysis to assist in forecasting, budgeting, and maintaining corporate integrity. Avise will allow your fastest growing clients to focus on their business, stay SOX compliant, and go public, instead of spending time and resources on a large and costly ERP migration. To learn more about how Avise can help you extend the life of QuickBooks Online for your clients, head over to earmarkcpe.promo/Avise. That is earmarkcpe.promo/AVISE. Avise. Finance professionals deserve better. So you're tracking orders, you're tracking ad spend. Anything else?
And and then the next most important one to us, that then became the most important over time, was tracking people continuing to use the bikes and continuing to pay their monthly subscription. Though we tended to view that as a downstream metric from, are they actually using it? And we'd be focused more on that.
So usage, I mean, I know the bikes are connected to the internet, and I guess you know when somebody starts a workout, right? Every time. Is that what you were tracking? Like how often they're using the bike?
Yes, that's it. It would be, we'd be focused more on completing a workout.
Completing, yes.
Whatever we thought was a good proxy for, yes, this counts as a real workout.
Yeah.
And if the connected bikes are, you take a class on it, it's saved to your history. So it's available to be aggregated in an anonymized way to the overall statistics. And yeah, we'd be looking at that recurring revenue and trying to calculate lifetime value based on those early indicators.
Lifetime value. So you could anticipate churn on the subscriptions based on how much people were using the bikes, I imagine, right? Because you could, was there a magic number where if they completed X number of workouts, you knew they weren't going to churn? That sort of thing?
Yeah, there was. We did look at it along those lines. It would be something like, if they do 6 workouts, then we know they're in. But the vast majority of people would do that. And what we'd really look for is, because the vast majority of people would get started, we'd look for a sudden shift. And so it would be a story, someone got injured or something like that. And then we try to predict, okay, well, who's likely to churn? But churn was thankfully very low. And we were able to start modeling out what our lifetime value is. And that was very important. Then going back on the acquisition side, saying, well, if we know this lifetime value is really high, then we're willing to spend a lot on advertising to get new customers, but not beyond that. And we still needed to know it worked. So we still needed to be very, very clear on what our ad spend really was. Because $1,500 for one more might be good, but it'd be very easy to miss a few data points, and it's actually $5,000.
Were you making money on the bikes? Were you breaking even? Were you losing money on the bikes and then hoping to make it up on the subscriptions?
It changed over the course of Peloton's history, and we always looked in a holistic view, and whether it was in terms of the initial gross margin, or the acquisition cost to bring in a customer, and then be able to get the subscription net of all additional costs. We wanted to make sure we were never really underwater on that one. But exactly as you say, with that subscription, thankfully people stuck around, and so we could be fairly confident we'd end up ahead.
Were there any big financial disagreements at that stage of the business?
I think in the first few years, and so I'll say, in the time before we were really looking ahead to IPO, for sure there were strategic questions and discussions that were informed by the financials, and it was questions like, how should we calculate lifetime value? What discount rate should we use? And what long-term churn assumptions should we make, given that most people had only had a bike for about a year? Trying to extrapolate to what their churn rate's going to be in year 5 would be a little tricky. And then we could say, well, if they stick around year 5, the churn rate should be lower. We could say, well, they're 5 years older and their life was changing, maybe it should be higher. And so there's some of that discussion. And also on the acquisition, that was, it's something scary to say we should spend this much on marketing because we have the confidence that the lifetime value is higher, because that's cash now, and like one's kind of a certain and the other's very uncertain.
Yeah.
And even though the discount rate factors in, it's tough to know.
Your lifetime value is when you've only had people on a subscription for a year. How can you possibly know that they're going to, it's a guess, right? You're making a lot of assumptions on that lifetime value. So I imagine it could be a huge range depending on whether you were conservative or optimistic.
Oh, absolutely. It was, we could say we should pretend it's 2 years worth of subscription. We could tweak a few assumptions very reasonably and say, oh, well, actually we should think of it as 10 years. And we actually had on our acquisition team and acquisition/business intelligence, because it was that important, we hired someone who had a PhD in math from MIT to help crunch through all of it, and who solved all sorts of problems, but even he had to throw his hands up on the LTV calculation to say this is really more of a philosophical question than a math question.
Well, you must have guessed pretty accurately, or at least good enough, because Peloton did go public and it seems to have done fairly well, I'd say. I think most people would say. I don't know. How do you feel about it?
I feel great about it. I feel like we set out. Yeah, we set out to introduce a product that we knew was great, that we ourselves loved, and we wanted to introduce it to as many people as possible. And Yeah, I think we were fairly conservative along the way on acquisition. We really held ourselves to high standards, and we ran a World Series ad 1 year, and we had all sorts of metrics, partly thanks to that MIT math PhDs, to show that was a huge success. And then the next year, we bought 6 World Series ads,
Wow.
and our data showed that, okay, well, then we overshot it. That wasn't worth it, and so then we pulled back from there. We were honest with ourselves whenever things weren't working, and so yeah, and we got to IPO, and we went from years of no one having heard of Peloton to everyone having heard of Peloton.
Well, and my friends who own Pelotons are very vocal about it. They are big fans, and I've always admired that about the company. It's that like the users are very passionate.
Yeah, and uh, that obviously is something we hoped would happen. We believed would happen, but the community still surprised us, and it was fantastic. And the riders turned out to be great people. I think they genuinely are great people, but it's also a very positive kind of environment where people feel good about themselves when they take a Peloton class.
So let's go back to the accounting system, because we like to talk about accounting systems on this show. We like to nerd out about technology and apps. And so I'd love to know more about that early app stack that you were using for accounting and finance at Peloton. What did you add on to QuickBooks? Or I guess tell me about the journey of where you went, because I don't imagine that the Peloton stayed on QuickBooks all the way through the IPO. I imagine you had some systems changes, and that can be quite dramatic. So I'd love to hear that story.
Yeah, it was definitely dramatic. But yeah, correct. The answer is we were not running on QuickBooks at the time of the IPO, though. I have since heard of at least one well-known public company that was running on QuickBooks at the time of their IPO. It happens.
Is that the Uber
Uh,
story you're talking about? Because I know they were on like QuickBooks Desktop with hundreds of thousands of vendors in there for a really long time. I don't know if it was all the way to the IPO though.
yeah, I don't know the details on that one. I have heard that as well, that they pushed it pretty far, but
Yeah.
I believe they had made the transition by the time of IPO. I think it really speaks to, stories like that speak to how these businesses aren't really operating on the general ledger and the numbers coming out of it. I can't believe Uber was making all their critical business decisions when worth tens of billions of dollars without any insight into their business. And my guess is, without knowing anyone over there, that they were viewing their QuickBooks instance as an afterthought. No, well, we just have to get the books done. And like us, they were making business decisions on non-accounting systems. And yeah, that certainly was where we were at Peloton. We had a homegrown e-commerce system, for better or for worse, and certainly felt like for worse for much of the time. And we had an AWS Redshift data warehouse that could ingest all that data and all the usage data, and that was the domain of that MIT PhD. And we had various other external systems that would be aggregated via spreadsheets, but it would always, it would go in different directions. So that the data would be pulled together by different groups of analysts, maybe by FP&A and by business intelligence, and then it would go to where it needed to go for decisions to be made in a not so great, not really a trackable way. And then it would also go to the accountants, who were sort of at the end of the queue, really, for getting the data into. We were running on QuickBooks Desktop at the time. And that meant that no decisions were made really based on what the accountants did. And there were certain murky parts of the business where I would literally lose sleep at night worrying, like, what if we're missing something really big here and we don't have the safety of double entry bookkeeping and the audit and rigorous accounting practices.
Right, because you're making business decisions based on what's in that data warehouse, but that hasn't been reconciled.
Correct. And if we worked really hard, we could almost reconcile it. But most of the time, the teams are too busy to even do that on a regular basis. And so I had the genius idea that this thing called enterprise resource planning could solve all of that. And I'd say that's sort of on me for not appreciating that an ERP is a tool where you can put all that data once it's clean. But at least in our case, it didn't clean the data. It didn't solve any of those underlying issues. And really moving to an ERP now just added yet one more thing that we had to contend with while running all the other somewhat messy processes.
So you went from QuickBooks Desktop to what?
We implemented NetSuite. It was a lengthy process and the business was complicated. And so the NetSuite team rightly told us, well, you're going to need to work with some good implementation consultants on this. And then that got a little complicated. And we realized, well, we now need people to manage the implementation consultants and this process. So we hired Enterprise IT. And Enterprise IT said, okay, well, this is fairly complicated. There's a lot of work to do here. We're going to need other consultants as well. And it very quickly turned into this big, hairy operation just to get us on to NetSuite. And meanwhile, none of this really addressed the core underlying problems of clarity, of getting the books closed in a timely manner. And I think it was necessary. I mean, we were going public at some point. We needed to be on a system that would satisfy the requirements of Sarbanes-Oxley for us. We couldn't stay on QuickBooks Desktop to go public. But yeah, I had the learning experience of finding out that just implementing, one of these best-in-class ERPs doesn't fix all the inputs or any of them.
So my co-host of the Cloud Accounting Podcast, David, and I have been to Suite World for a few years now. And every year we go and we get to talk to customers and partners, and most of the people there love it, right? That's why they're there. They're very happy. But every single one of them says, yeah, the implementation was a lot of work. And they don't skirt around that. That's like the biggest complaint I hear about ERP systems is, oh yeah, our implementation took 12 months. And I'm thinking to myself, oh, and a bunch of consultants too, right? I'm thinking to myself, wow, I don't have 12 months as a startup founder to deal with this. Like, what makes it so difficult?
Yeah, it's a really good question, and because just thinking about software, it shouldn't need to be so difficult, and that's ultimately, and I'll get to it in a bit. That's ultimately what led to Avise. What would the software be that wasn't so difficult, that didn't require this big implementation, migration and implementation, and I think that's I think that kind of gets to it. I mean, the word migration is, to even get started, the data needs to be in a different form than it exists within QuickBooks. So there's all sorts of reworking of the chart of accounts and decisions to be made about to even migrate the data that exists in QuickBooks.
Yeah, that's a nightmare. That's a nightmare.
Yeah.
Right?
It's absolutely a nightmare.
Yeah.
We talk to people all the time who decide not to.
Yeah.
And I mean, at Peloton, we decided not to.
Yeah.
The implementation was painful enough as it was, without trying to shoehorn the historical QuickBooks data into it.
Even going from one small business accounting system to another, most of the people that I know that do lots of implementations have just gotten to the point of saying, it would be nice to have the historical data in the system, but the odds that we're going to be able to do that and cut you over so that you're not running parallel systems for months and months is very low. So let's just do a clean cut, right? And figure out a way for you to get your comparatives. Uh, I mean, I've heard stories about NetSuite implementations that just go on and on forever because they decide to try and get in the historical information. So then you're catching up NetSuite to what's in QuickBooks, and you're simultaneously trying to import your last month's QuickBooks into NetSuite, and the cutover never really happens, right? Because it's very difficult to run two systems at once. So I think you made a wise decision there, it sounds like, to not import the historicals.
Yeah, I think it wouldn't have been an option.
Let me ask you something else about.
Yeah.
Can I ask you something else about the NetSuite thing? So, was the goal when you set up NetSuite to try and bring in all of this management data that you were doing in separate systems into NetSuite along with the accounting, so that you'd have like one system for running the business? Because that's the big pitch of NetSuite, I think, or the big idea behind it, right? Or an ERP systems in general, like Sage Intacct will tell you this too. Let's bring in your operational data with your financial data, and now you get dashboards and all that great stuff. Like, was that what you were trying to do, or were you just trying to do it for the SOX compliance?
I think we started with the original goal, and then we fell back to the second one. So we started wanting to get all the operational data in, and we ended up saying, okay, well, let's at least get SOX compliance. And yeah, I think it's a very 1990s approach. And yeah, I think about the history of NetSuite. I mean, I wasn't really working with accounting systems in 1998 when they were released, and I can only imagine how revolutionary it was. But yeah, I do think back to the 90s, and I was working a little bit in the 90s, and I remember that a lot of companies didn't even have much of their operations on computers.
Yeah, yeah, that's true.
Of course, you need an all-in-one system because you don't have a system for most of what you're doing. And I hear good stories about companies that getting their operations on NetSuite. It clearly still works for a number of people today, but in our case, for the complexity of our business and the newness of it and how fast we were moving, it was just a mismatch to get all the operational stuff in there, which had big implications kind of all the way through. So it meant that these other systems that we thought wouldn't be in scope for SOX at all, or where the burden would be light, such as the e-commerce, aspects of the e-commerce system. Okay, well, they take the order, so that's in scope for SOX, but they don't need to maintain fully SOX compliant historical data, because that's going to live in NetSuite. And then we learned that, well, NetSuite couldn't really handle all of our data that way. And so now this system is in scope for SOX. Or I told the business intelligence team who managed the Redshift data warehouse that had all sorts of data in it, that while our work is hard enough as it is, let's be thankful that we're not in the flow for SOX. And then as we're about a year out from IPO, we realized there are a number of metrics that we want to disclose publicly that can only come from the system, that there's no chance we'll ever get out of NetSuite. And now this is in scope for SOX. But I think in our case, the NetSuite implementation, it still stayed pretty hard, and we're still doing a lot, but we just narrowed the scope to be the financials. And then that meant that everything else had to integrate.
So you're just pulling everything in from a financial perspective into NetSuite, generating the financials. So really it was SOX that motivated this shift then. What do you think about SOX? As somebody who has gone through it, do you think it's good for businesses? Do you think it's good for markets? Or do you think it's a waste of people's time? Or is it something in between?
Yeah, that's a really good question. I mean, now that I've been through it.
Did it make Peloton better?
I think it did. I think about the case of Peloton. I don't know. I think a lot of what we did to support SOX was good, important work. And would it have been possible to achieve most of those goals with a less stringent set of laws and regulations? Probably. And I think that, would degrees of materiality have helped, if we narrowed the scope on, okay, what needs to be penny for, like accurate to the penny, and what can we just have some confidence in it is close enough, versus like the same set of requirements apply to the core financial systems as apply to, really ancillary systems. But I think the spirit behind it was very good. The idea of, well, in order to take the public's money and investment, we have to grow up in terms of controls and having some rigor to the internal systems. And that was absolutely beneficial. I'll say it's above my pay grade to determine what level of mandates there need to be around it, but it was important work.
Well, I feel like I wouldn't say it's above your pay grade because you're an investor yourself in Peloton, I imagine in other companies now. And like, what's the purpose of all this if it's not to protect investors, right? Like, if it doesn't add value to investors, then why do we do this stuff as accountants? That's how I've started to approach a lot. And I feel like there's a lot in accounting that we do, like especially when it comes to audit, that really creates no value to investors anymore. And it's just a suck on and a drain on the entire economy. If you think about it, it's a tax on the economy that we do this stuff that people don't really seem to care about. When was the last time you looked at an audit report for a company you invested in? Like, nobody does, right?
Yeah, no. I don't dig too deep into I don't even dig too deep into the financials if I'm investing. But
right.
No, and it's helpful to see the story, and I think that is one. I don't know the true underlying cause, but I agree that is one of the tragedies of modern accounting, that so much of the work that accountants do doesn't inform business decisions, doesn't inform investing decisions, and is sort of rote busy work.
A great example is those metrics you were talking about earlier in this episode, where you said, we looked very carefully at acquisition cost and lifetime value. And that ratio, there's a name for the ratio. I forget what it is, right? But it's like your, cost to acquire a customer divided by your lifetime value. And, you want your cost to be less than the lifetime value, right? If you're going to succeed as a company. Otherwise, you're going to lose money long term. And nowhere in GAAP or in the published financial statements do we have any of those metrics as like defined universal metrics where everyone's using the same methodology of computing them. And I just wonder why. Why don't we have that in the accounting standards for subscription businesses, that you're going to report on, some sort of standards so that we can compare companies? But instead, here we are expensing all of our sales and marketing costs every single period, and there's no match between the revenue coming in and the sales and the marketing because, right, we're spending money to get new customers, but that revenue is down the road in subscriptions, right? So it's all mismatched, and that's why subscription businesses look terrible in public financial statements generally, because they're burning all this cash to acquire customers. They're nowhere on the balance sheet. But in the mind of an investor, those customers have a value. Right? Like, it just seems kind of mind-boggling that we're using industrial accounting for software businesses.
It is a funny situation, and yeah, I 100% agree, and I feel like the successful modern accountants, they hopefully understand this, and will understand this, and maybe it's not represented in the GAAP financials, but for sure, marketing spend should, at least conceptually, right? It doesn't need to be written down this way anywhere, but should be thought of as an investment that potentially can sit on the balance sheet.
Right. But instead it's a period expense. But really, like, if we think about it as founders, investors, it's an investment. It's CapEx, or it's some flavor of it. Right?
Yeah, it really is. I mean, if it acquires customers, that's a very clear one. That
Yeah.
these customers, that's a future revenue stream. That I mean, I get that it's a very uncertain value, and GAAP is necessarily conservative, and so you can't recognize something that very well might not happen. But probabilistically, it's going to happen, and especially
And
across all your customers.
there's a range,
But
right?
even
Yeah.
it's got
Yeah.
value. It's not zero. And even before that, even before people are customers, if the marketing team says we are buying these ads to increase brand awareness, well, then brand awareness has a monetary value to it and should also
Yeah.
sit on the balance sheet.
I think the thing that illustrated this for me really poignantly was what happened with Netflix earlier this year, where the stock price cratered because they reported subscriber losses for the first time. And I went into the financials and I downloaded them from, I think it's called Edgar, the SEC website. And I was one of, like 24 people to actually download the financials, I'm sure. Like that's the joke, right? So I looked at it and I'm like, okay, their EPS is good, right? They've got good earnings. They've got good cash flow. They've got plenty of cash on hand. And yet their stock price is tanking. And it's because of this one number, subscribers. And it's because I think that investors have figured out that subscribers are the most valuable part of a subscription business because they represent literally your future cash flows. But like that's only reported because Netflix chooses to disclose it. Like they don't have to. And I wonder why don't we have every subscription business report their subscribers and make an estimate of their lifetime value of some sort? I'd love to have that as an investor.
Yeah, I mean, for sure.
Yeah.
I think and so then what happens is every subscription business does report to some degree because they have to, and the investors expect it. So even if it's not mandated, people aren't going to invest if they don't have some insight there. But
Yeah.
you're right. Everyone calculates it differently, and I'll say that at Peloton, we made decisions on how to calculate the publicly released metrics, balancing the two sides of what we believe to be the most economically true representations of things, and also what could be calculated in the most straightforward way from other numbers in the GAAP financials. And I think that was a good balance for something that was defensible, digestible, and that people could shoot through. But it did leave more to be done. So we'd say, if this is our churn and you extrapolate that out, then you can assume that people will be paying us for this many years, and therefore and then implying therefore the lifetime value is the subscription times 12 times, for instance, 12 times. There's the gross profit on the subscription times 12 times the number of years, and we wouldn't factor in the discount rate,
Right.
but we took the stance of, well, of course you got to factor in the discount rate, but every investor can do their own calculation for what they think the discount rate should be. And why would we as a company make that call? That doesn't make any sense. But it's kind of that's a key final step in the calculation.
Right.
I'm sure like every hedge fund out there doing the investment and some very sophisticated people doing it, at least that calculation and more. But in the public filings, there's no attempt to come up with the true economic present value of a subscription.
So at what point did you hire a CFO?
Yeah, we hired a CFO. We had, in my time there, we had two CFOs. And we had the CFO that helped us get our house in order and the CFO who took us public. And we hired that first CFO just as we were getting started with the NetSuite implementation, which, I almost had to apologize to her for and to the rest of the team, because it meant that I could take a step back from the finances and no longer be directly in the critical path there, just as we had to get this implementation going.
And what did you look for in that first CFO?
On that one, it was the business. Yeah, the business had gotten complicated, and part of the motivation part of the same motivation for getting an ERP was that we didn't have much insight into the business, and operationally, finance and accounting was starting to get away from us. We had a monthly close process, and then it started stretching out to the point where it was almost taking a month to close the books each month. And I believe at one point we actually did get to a spot where it's taking us more than a month, so we're falling farther and farther behind. And so we looked for someone who had good operational finance experience. Companies of similar size had had experience preparing a company for IPO, or at least they're getting ready, and those were the key requirements when looking for a CFO at that stage.
So going back to the NetSuite implementation, the ERP implementation, it sounds like, if I could summarize, you had initially hoped that it would become the system for everything, both management purposes and financial reporting purposes. And you ended up scaling that back to just the financial reporting side of things. Was that challenge what led you to start Avise?
And that is exactly it. It was reflecting on that. It was the thought of, well, this was painful, and this was the end. This was the end result. What if there was a better approach? And really thinking, rather than what if there was an easier ERP out there or a better ERP? It was, well, if the financials and the compliant financials with the right controls that can house the data is the goal. What if there was an easy system that could check the box for the Sarbanes-Oxley requirements, and that could help get the close process wrangled, and be a grown-up real repository that could has the data, could support better reporting to actually support the business coming out of the GL, but didn't try to be the be-all and end-all operational system, and ultimately wouldn't really require a migration of any sort, could handle that automatically.
Automatic migration. Tell me more about that, because that is the thing that's the painful part, right? How do you... So I want to switch from QuickBooks to a SOX compliant GL. Avise is that. I love the headline on your website, by the way, freedom from ERPs. That's exciting. Yeah. So like, how does that work?
Yeah. And that's that's the beauty of it. I mean, it makes it easier for us too. And we integrate with QuickBooks. So, our pitch to QuickBooks is that we're not looking to move anyone off. We think about that Uber situation where they're using QuickBooks, when they're worth however many billions of dollars, where it's kind of sort of been working, but people are where we were at Peloton in terms of needing some more grown-up features, needing close management to actually wrangle the close, the proper controls, and needing some automation on schedules that exist today in spreadsheets. But otherwise, things have kind of been working with QuickBooks. So what we do is we plug into QuickBooks via the API, and we maintain a full bi-directional sync. You can tell your auditors that Avise is the system that has all the controls and has the record that you need, for being a more grown up business, but more grown up accounting needs. But the day-to-day operation in QuickBooks doesn't need to stop. There's no running two systems in parallel. It really ends up feeling like one, where you can do some of the work in QuickBooks day to day, and then you can do your closing entries and your whole close process, your reconciliations and reports out of Avise.
So I see here you've got close task management. You've got the prepaid, accrual, deferred revenue schedules, fixed assets in there. So work papers, essentially, it sounds like. And then you've got consolidations as well. So is your goal to be able to, like, could a company go public with their accounting data in QuickBooks and using Avise as the layer on top of that? Is that the idea?
Yeah, that's pretty much it. I mean, that is the goal, and we're working towards it. We have our SOC 1, and which I believe Intuit could provide for QuickBooks, but they don't because there's not much demand for it. And so, yeah, we can check the box on Sarbanes-Oxley for housing the data, but yeah, it's not a new system. We can.
Right.
We just have the controls on the Avise side that don't exist on the QuickBooks side. But we want to be modern, easy to use. We're building this in 2022. A lot of the features you see here were new this year.
Yeah,
and it's not out of the 90s. We care about the people using the software, and yeah, all that accounting busy work. We feel like that's the stuff accountants shouldn't be spending their time on.
And I see there's an AICPA logo on here. What's your relationship with CPA.com?
Well, that's our that's where we're going. We have our SOC certification.
Oh, got it.
AICPA SOC 1. We've been working with an audit firm on that one. Now we got our SOC 1 Type 1. We're, I believe, a couple weeks away, if that, from getting our SOC 1 Type 2 certification to actually be able to put up there.
Well, this is really exciting. I mean, it's sort of been taken for granted in the accounting technology world that you get to a certain size and you've got to get off of QuickBooks, or you got to get off of Xero, and you got to go to an ERP system. And you don't really have a choice in the matter. And this is the first time I've heard about an alternative pathway that could allow you to stay compliant and deal with all this stuff and continue to grow. So that's really exciting. Thank you for creating this as an option for people.
Yeah. Well, I mean, it's been fun. You asked at the beginning, what's the connection? How's the journey from Peloton? And it was the former Peloton CEO who said to me as we were getting started, "Oh, it's just like Peloton." Except whereas we chose home fitness, you chose the even more stodgy category of accounting software to go and apply modern usability and simplistic approaches to.
Well, the great thing about accounting software is that we don't have to ship bikes for thousands of dollars across the country, right, and manufacture them. That's nice. And it's very sticky, right? I think that's one of the things about ERP systems, actually, is that once you're on it, you never want to have to switch again if you don't have to. Although is NetSuite, is Peloton still on NetSuite, or have they gone even more upstream?
Yeah, I know they were looking into it. I never got the full story on where that ended up. And I left the company 2.5 years ago at this point. So I'm unfortunately out of the loop on that.
Got it. Well, I guess I just have one more question for you, which is, you've been in the shoes of a founder who's responsible for accounting and finance. You've been a customer of a CPA firm, at least one. You've hired CFOs. You have hired accountants. Do you have any advice for accountants as to how they can increase their value to somebody like you? What should we be learning? What should we be trying to do? What can we do to be better accountants, in your view?
It's a really good question. And I think the answer is coming from both sides, is to make business leadership and accounting more of a partnership. At Avise, we talk probably too much about Luca Pacioli, who wrote the first book on double entry bookkeeping in Renaissance Italy in the late 15th century. But that work really did revolutionize business at the time. And it enabled all sorts of more complicated businesses than were allowed before because of the power of accounting. And for whatever underlying reasons, we've fallen into this point where business decisions are being made based on systems that aren't the accounting systems. The most important metrics are not GAAP financial metrics, but the correct calculation still rests on so much of the same work that accountants do or could do. And when I think about it, I think that accountants really should be back in that key seat, right? Helping to give insight into the business, helping drive those decisions. And to frame this as advice, and so if you're an accountant, working in a big company, but especially if you're working at a startup, recognize that the job isn't just to complete the close checklist and deliver GAAP financials. The job is to deliver digestible insights. And the good news is the accountants know the business really well and are really well suited to do that.
Well said. Graham Stanton, thank you so much for speaking with me today and for recording this episode of the Earmark Podcast, which is available for CPE on the Earmark CPE app. So if you need continuing professional education, go download the app on the Apple App Store or the Google Play Store and take a quick 5-question quiz and get your CPE certificate. You have learned a lot. I have learned a lot. So I hope you have learned a lot and you've earned it. Graham, if people want to learn more about Avise, get in touch with you. I think you're hiring at Avise as well. Where should they go?
Yeah, well, you can find all the information you'd like initially at avise.com, but please reach out, get in touch. And you can find me on LinkedIn. You can drop your email address in the box, and we'd love to chat. And
that URL is avise.com, Avise. Graham, great chatting with you.
Yeah, great chatting. Thanks so much for having me, Blake. Really enjoyed it.